Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always with the University of Missouri's Ben Brown. How's it going, Ben?
Oh, I'm good. How are you, Will?
Oh, doing all right. Staying on the college football theme that we keep introing with, just living and dying with Mizzou right now, making sure they get a win. So far
Hey,
so good.
5-0. We'll take it.
5-0 for the first time in over a decade or right at a decade. So, yep.
Got a maybe motivated LSU team coming into Columbia this weekend. Should be a
Yeah,
good game.
that was a tough loss they suffered at Ole Miss. Some bad things unraveling at the end of that game for LSU, but a fun one coming up here in Columbia. Also, I have a wedding coming up in Missouri, so I'm coming up from Ohio, going back to Missouri for this weekend. So nice little double whammy for me.
Yeah, should
But
be beautiful weather. I think it's
yeah,
supposed to cool off a little bit
yeah,
down in the low 70s, upper 60s. It's going to be
exactly.
great.
Exactly. So, just to give an update on where we stand on the market real fast here. For December corn, we are up 7 cents in the week at 4.88. December 2024 corn up 8 cents at 5.17. November of 23 on soybeans down 20 cents at 12.77. That November 2024 contract is up 6 cents at 12.67. Soybean oil for December was really flat on the week on cents per pound, sitting at 57.43 cents per pound. Soybean meal by the short ton for December down $15.50 per short ton at 374.30. So some notable loss there. The wheat crop for December of 23 down 25 cents at 564. Wheat for July of 2024 down 12 cents at 631. And then crude oil for November down $2.38 a barrel at 87.24. So, Ben, really what seems like maybe some light adjustments there, but that doesn't necessarily mean it was steady the whole way through. What are your initial thoughts on the adjustments we saw this past week?
Normally, we're talking about corn and soybean production this time of year, but I thought probably what was most notable out of our weekly market recap was those wheat numbers, those wheat price declines. That was related to the small grain summary that we got on Friday, which accompanied that September 1 grain stocks report. Better wheat supplies out across the country than what was originally forecasted in August. Saw some increases in the spring wheat acreage and yield for some of those upper plain states that really kind of showed that we could have more wheat production than what was initially anticipated.
Well, and with that more wheat production and the hint that you kind of laid on that September 1st numbers from the U.S. grain stocks report, we saw things fall within the range between corn and soybeans, but soybean stocks really on the high end of that range. So we saw some adjustments there to the soybean market, especially. What's your takeaway as we move into October in this new marketing year?
Well, you're right. So soybean ending stocks came in 26 million bushels higher than expected. That was even despite a reduction in the 2022 soybean crop. So a reduction there of about 6 million bushels, which isn't a lot, but still, when we're talking about a reduction from last year, and then ending stocks still came in higher than what was anticipated, that suggests weak demand and that there's probably room for yield reductions and the ability to absorb some yield reductions without shooting prices drastically higher.
Well, and thinking about what this means from an X's and O standpoint on the farms that across the Midwest and the rest of the country, with maybe that demand being tempered a little bit, what is this going to look like as far as grain storage? Maybe some, costs there holding on to some grain for farmers.
Yeah, so I'm going to answer that in two ways. First way, certainly the on-farm stocks number, on-farm grain stocks number was probably the big headline, the storyline coming out of the September 1st grain stocks. While pretty much all commodities were down year over year. Wheat was the one exception, which was basically flat. Corn and soybeans were down year over year in grain stocks. It was those on-farm stocks numbers that were drastically higher, anywhere between 15 and 20% higher, depending on which states and where we were looking at across the country. That certainly signals that there's crop out there that is ready to move into the market, kind of as harvest continues to move along. And that's going to maybe create a little bit more harvest time pressure. And I think that was really what maybe dropped the soybean prices last week was this, large on-farm stocks number. The reason I say I think that played a big part of the soybean picture of the soybean complex is my second point here. First was the large on-farm stocks. The second one here is when we look at returns to storage between corn and soybeans, soybeans always has a higher cost to store than corn because one, we have a higher cash price. And so when we're thinking about interest expense in terms of just physically holding that crop, we have to take into account interest expense. That interest expense is going to be, the same percent, whether you're talking corn or soybeans, but because the cash price on soybeans is, 2.5% higher, sometimes it's more, sometimes it's less, but let's just use 2.5%. That creates a 2.5%, a 250% increase in the storing cost for soybeans relative to corn. And so as a result, normally producers are storing corn and selling soybeans through harvest. And I think that's what the market reacted to.
So, okay, Ben, let me break that down with you there for a second. So you talk about the soybeans, intrinsically being, having a higher cost of storage. You said that's because of a 2.5% cost difference, or do you mean 2.5 times difference there?
Sorry, yeah. So the price of soybeans is generally 2.5 times, the price of corn, and so they have the same percent, right? And
but it's going to stack up a whole lot quicker whenever you're looking.
Right now we're talking about 8-9% of those operating costs, right? You're going to take that 8-9% times corn and soybeans. So soybeans is 2.5% higher. Or excuse me, 2.5 times higher than soybeans. I think I said that again there, just 2.5%. It's 2.5 times on soybeans higher than corn. We'd expect that interest expense to be higher.
And as we're moving through harvest, looking at the updates, we're nearly a quarter through both for corn and soybean harvest throughout the country here. So how is that going to alter behavior maybe as we look at, the grain and oil seeds hitting the market this fall?
Sure. We've been tracking inspections of exports here the last couple of weeks. It really hasn't started to impact the corn market all that much because normally we are seeing a dominance of U.S. soybean exports. Every barge that's got to go south is pretty much hauling soybeans, getting those to international markets. It's usually a little bit later in the harvest window before we start seeing corn kind of take up some of that space, right? And so my response here is like with low water levels, certainly that's creating a logistics issue for us, but then also just the weak demand internationally for U.S. commodities is kind of backing this picture up some. Brazil, we've talked about it before, but Brazil continues to hold a pretty large or at least abnormal size of the global export market during the month of September and October than what we've normally seen them have. Just to give you an example, here in September, Brazilian soybean exports were, a little over 6.25 million metric tons. That's up from 3.5 million metric tons during September of last year. So 100% increase in soybean exports from Brazil during the month of September. All that's to say is I think we're backing up our soybean export window, and that's going to delay corn exports a little bit more too. And as a result, we'll probably see basis levels kind of react and be a little bit less seasonal than what we've normally seen them, right? So, not seeing some of that export market seasonality that we've come to experience during the harvest window.
Well, and one of the things that you talked about when it comes to Brazil kind of holding a lot of the export market hostage, and then looking at some of the shipping issues that we've had looking in the recent months and recent years, really at the low water levels, it's going to take a fairly big amount of, return to water flow into the Mississippi River Basin to maybe limit some of that cost and increase some of that barge traffic. So as you look at it now, you're getting increased costs when it comes to shipping too. So that's also a disadvantage maybe on the global market. I don't know if you'd agree with that or not, but
I think that was really my 1-2 punch there, right?
Yeah, exactly.
Being the low water levels, 2, the lower appetite on the global marketplace for U.S. based commodities, and that's just delaying, that's backing up our export window on soybeans, which will then ultimately impact our export window on corn.
Yep. So Ben, looking forward into the rest of this week, what should farmers and ranchers really be paying attention to?
Yeah, well, so it's kind of a little bit of a unique week from the standpoint that we have a holiday on Monday, Columbus Day coming up on Monday. Markets are actually open on Monday for Columbus Day, but the USDA does delay reports a day for the holiday. So markets open on Monday, but all of our normal reports delayed a week as we think about, the upcoming holiday.
All right. Well, thanks again, Ben. It's always great to have your information on here. Viewers and listeners, if you'd like to learn more, you can go to brownfieldagnews.com. You can also find more information on our sister program, the weekly livestock market update, at that location. Ben, thanks again. I'm Will Robinson on Brownfield.